Yeah, it's connecting to LinkedIn. I haven't done
There
this
we
on LinkedIn
go.
yet, so it's gonna be interesting to see. But we are live on YouTube.
There we go.
We've got people in the studio, although I'm not sure how to. Oh,
I
there we go.
see 5 in audience already. Hello, 5 in audience already.
That's so funny. I cannot. I can see 5 in the audience, but I can't see who. Where are they? If you're here, drop in the chat. Say what's up. I see Brian.
Brian just went. Hello, Brian.
I'm gonna. Who else we got here?
It's got to be more than just Brian.
Oh yeah, I can see 6 people in here. I just they're not jumping in the chat. Jump in the chat if you're here. I want to know.
Yep, I see you're live. Yep, there you go. Yeah, you're live on YouTube. Yeah. Oh, man. My audio just came through. All right, cool.
Where are you, Phil?
I am in Hollywood, California. We're working out of the 5X media office. So I'm sharing an office with my head of sales, Brian. So,
Nice.
yeah, beautiful day. How about you?
I'm at home. I live in the South Bay.
There we go.
Yep.
What area in the South Bay?
I live in Hawthorne,
Mm,
which is, it's I like to say Manhattan Beach adjacent.
there we go.
Yeah.
Love it.
Yeah. I love how LA has all these neighborhoods that are like nice neighborhood adjacent. Like there's Beverly Hills
Right.
adjacent,
Yeah.
and a bunch of others. So I'm like, yeah, we're Manhattan Beach adjacent. That's cool.
Yeah. Well, I live in Mid City, which is Hancock Park adjacent.
There you go. There you go. I lived in Mid City too.
Uh,
I liked living there. It was
I
very
like it
convenient.
for sure. For sure.
Sweet. We've got, excuse me, we've got like 11 people. More coming out. So if you're here, can you jump in the chat? Say what's up. Tell us where you're coming from. What you're doing. Are you a creator? Are you in the industry? And then we can just get into it. All right. Where I see 11 people, but I don't see the names, which is interesting. I think I'm gonna need to. I'm using Riverside. They sponsored my newsletter last week, so I was like, I should use it. And it's pretty nice, but I cannot figure out. I can't see the actual people that are in the stream, so we're just gonna do it live, as they say. Fuck it, we'll do it live.
Hey, there we go.
Hey,
Bill
all
O'Reilly.
right.
Whatever happened to that guy?
Man. All right, so thanks everyone for joining. I'm Avi. I write Creator Logic, and I'm joined here with Phil Ranta, the CEO of Stealth. I want to learn more about this, Phil. But Phil's got a pretty wild background. He once beat me out for a job as the head of gaming creators at Facebook.
You should have gotten that job.
No, you were much more qualified. I was number 2 in the running, but he edged me out, and you know what? He deserved it. But he's been in the space for as long or longer than I have. You started as a creator, didn't you? You were like
I was a stand-up
YouTuber
comedian
back in the day. Yeah.
Well, I was technically a MySpace video creator
Oh my
back
God.
in the day, because I would post my stand-up clips there because it was just getting better views than my open mics.
That's amazing. And then you led the network at Fullscreen. You were the CEO at Studio 71, head of gaming creators at Facebook. Head of creators at Mob Crush, COO at We Are Verified, chief business officer at Fixated. So quite a lot of C's in your resume, which is either mediocre or impressive, depending on if it's a grade or a title. And those look like titles, so more impressive than mediocre. It's pretty cool. And so you've been like leading the space for a long time now. You've kind of is this like the first thing that you've launched for yourself in a few years now?
This is, yeah. I've had CEO titles in the past, but it was never companies I founded. And then I've also had founder titles in the past, but I was never CEO. So this is the first time ever where I said, I am going to start a company and run it. And so far, so good. We're only technically 60 days in, but it seems like with a pretty kind of radical idea, it seems like it's been resonating with the market.
Yeah, so tell us about it. Let's start with that. Well, like what is this new company? It's Stealth. Is it Stealth Media?
Stealth Talent.
Stealth
Yeah.
Talent. So I'm guessing that's kind of an ode to like how everyone's always building in stealth. Is that kind of the
Yeah, well, it was a little something it harkens back to our main premise, which is, I mean, you and I have both been in this business forever. Everybody who was famous on YouTube 15 years ago either found ways to pivot and build out their media company or sell their media company, or they don't work in the content creator world anymore. Or maybe they're a digital marketing manager somewhere,
Yep.
and we've seen this in Hollywood and sports and everything else for years. You're famous, and then you go away, and then you're started a used car lot, right? It doesn't have to be that way, because when you're famous, there is a chance to start building real ownership in things that can outlast a relatively short creator career, or at least on average, relatively short, right? We call it investing with your influence. There are a lot of startups out there that are brilliant, where it's CTO founded or has an awesome product that they invented, and they're failing as they just don't know how to market, or they don't know how to go to market, or they think they know how to go to market and end up raising $300,000, then trying to spend a bunch of money going to market, and then they fail. Creators are awesome at going to market.
Yeah.
And the aha moment was, I read a report that said the average startup raised about $150,000 to get from 0 to 1 in terms of marketing. Usually, whatever, first 1,000 customers or whatever you want to call it. It takes 6 to 12 months to raise that $150,000. That's generally 5 to 10% of their company. And they do it for their first 1,000 customers. And I couldn't stop thinking, like, I've got tons of creators that can do a tweet and get 1,000 customers, especially with something like app downloads or signups where it's free. Heck, I got people that can do, for $150,000, I have people that can do 200,000 downloads, right? So that led us to start this company where we're really trying to crack the code on how we can get creators on cap tables, supporting companies, and also providing liquidity along the way by way of more traditional representation methods, brand deals, and platform deals and things.
Okay, so it's a combination of starting companies as well as joining companies in the early stages. Like what stages are we talking here? Like what's kind of the ideal business for you to partner a creator with in your mind?
We're learning a lot very quickly because this is a reasonably new concept. So we put it out to market and we were curious what we'd get back. And at first we thought, yeah, this is just going to be pre-seed dorm room style companies. Let's find some gems and let's push it out, right? And we have great venture partners. Nobody Studios is our first investor and venture partner. So we're building within a venture studio. We're also working with Butterpie, who have done over $1 billion in GMV on CPG products end to end, from formulation all the way to execution. 5X Media for IP building in Hollywood. So we've got great infrastructure to get things out. But we figured on this front, it would be a lot of people who are like, hey, I invented the world's greatest microphone in my dorm room. Let's go do this. As we're going out to market more, we're starting to find a lot of companies that are 2 years or 3 years or 4 years out who are doing okay sales. They're kind of out there, but they're feeling the pressure of AI, of the market, and they say, oh my God, I did not put enough urgency behind my marketing. Or they went out and spent their pre-seed money and the marketing didn't work and they're panicking. So we're now structuring ways for them to live to fight another day. Of course, we have to be picky. We have to have products we actually believe are going to do well. But if it is a product we believe they're going to do well, a lot of it is, I won't call them distressed companies, but I will call them companies that are like, have this one blocker of marketing or initial app downloads or whatever that we're helping them solve.
So it's the formula is really like great product, great team, like not great at marketing.
Right. Or just does not want to go through the hassle of fundraising for marketing and then figuring out marketing. They're like, I just want to be able to flick a switch, and just say like, get my first 1,000 customers and find hopefully a creator that will understand how valuable their equity could be and support it on the long term. But I mean, you know how it goes. You've been working this market forever. You have to kind of treat it like an influencer marketing campaign, right? Where it's like you might vest over 3 years and you've got ongoing promotions you have to do along the way. And if they flake out, we have ways to be able to cut it out. And but that kind of back and forth and figuring that out it's tricky. It takes somebody who's been in the market for a long time, who's clear-eyed about both sides in order to get it done. And legal compliance, of course, not providing financial advice, not providing legal advice.
Right.
And so we're trying to solve that problem. Right now, I would say we have not solved that problem, but we're excited to continue going through the path of solving that problem.
Okay, so I have lots and lots of questions. We're going to
Sure.
come back to equity and talk about equity and kind of how it could be valuable to creators, how it might not be, all of
Yeah,
that. But
sure.
I think first I want to kind of get into, I think the probably the biggest thing that a lot of people generally think of when they think of startup, which is risk, right?
Yeah.
Startups could go to the moon, but for every startup that goes
Mm.
to the moon that becomes a unicorn, there are
Mhm.
thousands that just completely go under.
Yep.
So how are you evaluating these companies? Because obviously you don't want to necessarily, you want to minimize the number of the amount of effort a creator's putting into a company that isn't going to be successful. Creators
Mhm.
are looking to you probably to evaluate on their behalf because they're focused on content. Like, how are you approaching this?
Yeah, so we highly depend on our venture studio partners to be able to do some of that vetting for us. Because you're right, if we were doing diligence all the time, that we're a 4-person team, that would be our entire jobs, right? Like go to Rockwater, whatever. Like we
Right.
wouldn't be able to handle that. But when it's something that has a chance for ongoing liquidity, it is absolutely more valuable to us. So there's a lot of creators out there that are doing $10,000 deals one after another. It's a pain in the butt to get going. But they have great conversion and they have a great market fit. It is entirely possible that they can do equity plus cash. It's just the cash will be based on successes. So let's go back to the original example that I talked about, where it's like people are spending $150,000 to get their first 1,000 people, right? And a lot of these creators can do it in a tweet. That tweet, though, they might sell the brand for $2,000, right? So if this product has an LTV with the customers, or even if they've got an affiliate program built on something like impact.com, and let's say they're paying $5 a download, right? Then they would easily be able to get to that cost for their tweet and far surpass it for the cost of their tweet just in cash alone. But they need the incentive to also go and do it and support it, and that's where the equity kicker comes in. So instead of a creator going out and doing a $2,000 brand deal, they might do a brand deal where they might get $5,000 or $10,000 on this cost per acquisition model, and then also get 5% of the company or 10% of the company. So it's a win-win-win all across the board. The company saves time, they save money, they save equity going to somebody who is not as powerful in terms of ongoing promotion. And the creator is still making money along the way with this chance of what we say a lottery ticket to possibly make a lot more down the line.
Got it. So to summarize, you're leaning on your venture partners to help with vetting and identifying the right companies, and you're structuring your partnerships so that the creator, rather than getting paid a ton up front, because obviously that doesn't really work well for these kinds of companies and their budgets, you're incentivizing them with a combination of performance-based cash, right? Commissions, bonuses, whatever it is, and equity if they're hitting certain performance targets in terms of actually driving sales.
Yeah, and we have to get clever based on the company, because every company is a unique unicorn, right? So it's like some of them don't have ongoing liquidity, but the way that we've got that figured is, well, we might be able to help you get to a Series A heck of a lot faster. So if a Series A gets to X amount of number because of this creator, maybe we get liquidity on that, right? Performance based on a heck of a lot more down the line. So somebody might get equity plus success bonus if we hit this certain benchmark when money does start flowing. So instead of that $2,000 tweet, they might get a $30,000 bonus if they're able to get the Series A up to a $10 million raise, right?
Yeah.
So it's a
Which
lot of
I've heard
math.
that happening with employees as well, right?
Yeah.
Like, you know, if you hire someone super senior
Mhm.
early stage, they might, you know, take a lower salary, and then, you know, the agreement is that if you raise a certain amount at a later round, they get a bonus and their salary increase or whatever, right? So like
Yeah, that's the
that,
boring side of what we do, right? Is a lot of these are tried and true methods that have been used for employees or marketing in the past, but it's been inaccessible to this market, especially the smaller companies, right? Like bigger companies will get this because they've got very smart lawyers working on it. We have a lot of companies that are like streetwear brands that are awesome, but they're not necessarily the kind of people that have ever dealt with a cap table. So being able to show them that pathway has been pretty fun.
that's cool. Have you how how do you then wrangle the creators, right? Like I think one of the big challenges a lot of people see is um keeping creators interested, keeping them engaged. And obviously, you know, not every company is going to be like a, you know, you're not going to necessarily tweet once, see a bunch of sales. Like sometimes it's a
Hmm.
build. The
Yeah.
product improves over time and something clicks eventually, right? Um,
Hmm.
and you know, in my experience, right, like at Patreon, for example, like so often we would see creators uh, you know, post a couple times and like it doesn't like work immediately and they just bail.
Right.
And so I'm curious, like, how are you kind of wrangling the creators? Because obviously the companies are putting their trust in you as well, right? If they're doing the deal like this,
Hmm.
they're probably betting a lot here.
Yeah.
And so, yeah, talk about that a little bit.
Yeah, much in the way that we do diligence on these companies, we have to do diligence on our creators too, right? Like there's always inherent risk when there's creators, and a lot of creators just don't get it, right? There's a lot of creators where when I first pitch, they go, "That's amazing. Bring me any companies you might think is a fit." I'll bring them a company, and they're like, "Cool. Will they be able to just like pay me 100 grand up front to promote this?" And I'm like, "That's the exact opposite of what we were doing, right?" And there were, I would say, 9 in 10 creators are just we pitch and we're like, you know what, it's not going to be right. But if you can find those people who understand, and the best social proof for this has been Ryan Reynolds and how famous his career has
Mm,
been. Because, yes, as Jim Lauderbeck correctly pointed out, he's like, everyone's talking about Ryan Reynolds, but he was an actual investor in the company. And we're like, yes, but also, right?
right.
Yes, he did invest cash, but also he was an equity owner. He was a full throated supporter, and he was able to make hundreds of millions of dollars out of that equity pool. Likewise, we want to find people who go, oh, I want to take the Ryan Reynolds ride. And usually these creators have 3 factors to them. One is they have incredibly high career intelligence. They understand that being a content creator is not something that most people get to do for 10 or 20 or 30 years, and that this is like a moment in time that they need to capitalize on. Two is they need to have the business savvy to understand that companies have ups and downs, and it's not going to be an up and to the right. And if it is, awesome. If it's not, you have to believe in the vision of the company and the people in the company until it's time to not believe in it, and then let's have that tough conversation. But and then the third thing that they need is an actual lean in audience, right? We can't
Yeah.
have vanity metrics. And our partners at Trudy.app have been fantastic for this. They're trying to crack the bottom of the funnel code with top of funnel analytics. We're also working with Sourcify, who's helping with a lot of that kind of like who's the recurring performance brands that are buying recurring performance based creators, which is a strong indicator that they're getting strong conversion and returns that we can engage around. So we're really like cobbling together all of these disparate pieces. And then, of course, top LTK creators, no brainer, right? It's like if you're doing a fashion line or a beauty line, it's like we know they sell. They have trained their audiences to sell. So, yeah, we're getting really crafty on how we can have more predictable success. And if we can do that, then hopefully they're not going to bonk out on the company because they should be moving the needle for them pretty sizably.
Let's talk about a little bit more about like the deal terms
Mhm.
that you're working with here. So okay, you have a creator that you've brought to the table. Company is interested. Is there a place that you generally start, or like
Mhm.
are there different frameworks that you use depending on types of companies? Like talk about how you sort of think about deal terms.
Yeah, we have a framework, and the framework always breaks and changes, but it's nice to have a starting point, right?
Totally.
So
Yeah. Yeah.
we look at creators in 3 different ways when a creator is coming onto a cap table. One is just a creator advocate. This is generally that kind of 0 to 1. I want them to support it to start, and then they can bug off, and I don't care. And you can keep them in the deck, and you can keep their email, and you can give them a call, but they're not promising long term. It's usually 0.25 to 0.5% of the company. Can be more if it's like a very, very immature early stage company, but for the most part, companies are looking around that range. And these are creators that are generally top of market, but smaller creators. So let's say you launch a plumbing app and you want something to talk to all the plumbers in the world, and you find a newsletter with 10,000 diehard plumbers, and you just want 4 weeks of ad inventory on that to get you 500 plumbers to sign up. Awesome. 0.25% of equity. They're giving up maybe $30 in ad revenue. Win, 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 right? The second one is creator ambassadors. This is generally 0.5% anywhere. I mean, we thought we'd cap at 5%, but we started to see people willing to give up a little bit more for this. This is generally vesting over 2 or 3 years, ongoing promotion. We're treat it like influencer marketing, where it's like 2 Instagram stories shouting this out and 1 appearance at a live event. And maybe you have to show up at a board call or yada, yada, yada. We structure that appropriately based on the size of the company.
On like an ongoing basis, like, per month or per quarter or whatever it is.
Yeah, and our technology partner, which is at Ohm.ai, they have a very good structure. It's almost like Carta, but for influence.
That's
built
cool.
out really awesome stuff for that. So they know if they don't deliver, that meter stops going up, right? And their equity stops vesting. But of course, the goal is not to do that. So it does vest monthly, which creators love, because when we're like, oh, it triggers every 6 months, there's a higher chance that they'll drop out. But Ohm has built out the technology by which they can always kind of see their number going up, along with, based on the growth of the company, projected value. So it's like, it's able to get it down to more of a creator level. So if you have not checked them out yet, you should hit up Jeffrey. He's a genius when it comes to creator equity. And without him, I don't know if I could launch this company.
That's OHM.ai?
OWM.ai.
Oh, OWM.ai.
Yeah.
Okay.
But
That's
they're
cool.
great.
I didn't like Carta for creators, basically. That's feels like, well, I mean, feels right now like a niche idea, but probably long term, it's really actually quite the opposite, right? Like this is kind of where the world has to go.
What happens when nobody has money but people have influence, right? Like, I think that you and I probably share some of these thoughts of the kind of scary doomsday version of the future that might happen, where like the gig economy becomes the economy, and nobody knows how they make their money. But the way that you have to make your money is like whoever holds these levers of power, you have to find a way to be able to participate along the ride. So investing with influence starts to become pretty interesting,
Yeah, that's interesting. I never thought about that, but well, I think about whoever holds the levers of power, like running the world, probably way too much. But I've been saying kind of the creator economy is becoming the economy. I guess the gig economy is like the flip side of that coin, right? But I think those two will probably blend. Like maybe not with Uber, although it would be interesting if like you could pick your Uber rider. But for example, like eventually, platforms like Fiverr and Upwork and all of these kind of freelancers, like so many of them now are being driven by content. I'm curious, like obviously the creators that you're working with are higher level, like celebrity level creators, right? What about like these types of people that I'm talking about, right? What about like the advisors and consultants and freelancers, folks who have audiences, maybe smaller audiences, they're providing services. Like, is there a world where this sort of model works for them as well? Or is this really more for, and by this, I mean like the kind of equity-based compensation, performance-based compensation, maybe alongside cash? Would they even be interested? I'm just curious kind of your thoughts on that.
Yeah, I mean, and the celebrity part, just to finish out the third tier, is like a creator partner, right? Which is 5 all the way up to 51%. We had somebody come in and say, I will give majority ownership if they do a full-throated thing, which I never thought that this company would go that direction. But and that's Mr. Beast and Feastables, right? They live it, they brand it, it's them. When it comes to smaller creators, I think that we have not built it yet, but we're definitely looking at it. Like, how can anyone participate in this? Where if like my mom wanted to send out a Facebook post saying, my boy Phil has started a new company and you should promote it, and that gets me 30 customers over in rural Michigan, right? She should probably, based on the value of those, get $300 in equity in my company, right?
Yeah, yeah.
It becomes a regulatory nightmare, which is
Right.
why we aren't saying, heck yeah, let's go do this. But I think that there is a future where if you are a very long tail creator and you're not necessarily the kind of people that we would have the time to go do custom agreements for like 0.25% is kind of as low as we would consider going unless it was a multi-billion dollar company where 0.01% is so valuable that like
Right, right.
we still go for it. But like I do think that if we can figure out how to crack the regulatory framework, we might be able to go long tail as well.
That's super interesting. There's something I was thinking about recently is like I'm launching a subscription product in the next few weeks, and like I
Mhm.
was thinking about, could I give creators equity in it, right? Because like
Yeah.
every dollar they spend is will be returned to me in success as a multiple, right? Like
Right.
you spend whatever $100 a year, and a subscription business has like a 10 to 20x multiple on that. So like,
Mhm.
that's actually like you're giving me $2,000 again in success.
Yeah.
Like maybe it becomes nothing. And
Mhm.
so, it's not crazy to them think like, well, could I turn around and return, like allocate a quarter of the
Mhm.
equity towards the creators who are using the product? Like, in
Yeah.
success, like I'd be paying some of them back more than they spent, be paying some of them back, like a portion, like, I was just mulling on that. But then, to your point, like I didn't even think about the regulatory side, but like the
Mhm.
actual execution of that seems so difficult. Maybe that's something OWM.ai can work on. Because like I do think
Totally.
there's a world, when I think about like, okay, well, like we talk about how all these platforms like the TikToks and the YouTubes and the Instagrams like kind of are building so much wealth for their owners off of creators' labor.
Mhm.
How do you return that, or how do you disrupt that, especially now that they're so big? And like in my mind, one of the only ways is for a platform to come along and say, okay, well, if you're a creator on this platform, you're also an owner of this platform.
Right.
And like, inertia means that Google will never do that,
Right.
Meta will never do that, and so it has to be a new company.
Mhm.
But there is the question of administration. How do you actually administer that? How do you actually determine who gets what and how much? And it's that non-trivial problem. But
Right.
I do think like this is kind of the future, right? Like what you're doing in my mind is the first wave of what should and may eventually be the norm, where
Right.
companies that where creators are their customers or their clients or they're monetizing creators or whatever it is, are also making those creators owners who benefit from the long-term success of the company in the
Mhm.
same way that employees do, right? Because you
Yeah.
could you could argue that like there's a lot of creators on YouTube that generate a ton more value for YouTube than any
Yeah.
miscellaneous YouTube employee. No offense to any
Mhm.
YouTube employees on this
Sure.
on this
Some are
stream.
good.
So,
No, I'm just kidding.
right, but like those YouTube employees, as long as you're there for 5-10 years, you're a millionaire.
Right. Yep.
And so I don't know. It's like yeah, it's just something I think about a lot.
Yeah.
And
Oh, some people have thrown out the phrase participatory capitalism, right? Where it's like if you are adding value, you get money out, whether or not there is a formal contractual way of handling that. I'm a
interesting.
believer that there will be more. I mean, that's not going to be like the norm, right? It's not like every time I buy Skittles, I get equity in Skittles as well.
Right,
But I
right.
feel like there's going to be some movements in that direction. I think that it's a positive direction in terms of like average people not getting screwed over, right?
Yeah, I mean, you
Um,
could argue, right? Like with Skittles, for example, you're the customer, right?
right.
You're transacting and paying them money. But like
Mhm.
YouTube or TikTok, the creator's not the customer, right? Like
Right.
the creator is a vehicle whose labor drives the purchase.
Right. Yeah.
And so I'm speaking on a panel in January at UCLA's law school. They have a law professor there who wrote like a paper published a paper on like the unpaid labor of creators
Mhm.
in platform capitalism,
Yeah.
and it's like a whole law symposium about platform capitalism. So it's interesting. Like this isn't just something that like we who are in this space think and talk about. Like it is now becoming a more mainstream question as more and more people become creators and, you know, maybe are struggling to pay their bills while, you know, these companies are valued in the trillions. So,
Right. Yeah.
it's a interesting question. Anyway, I'll back to our core conversation. Okay, so you've got these three models, which sounds like advisor, ambassador, and like celebrity
Partner. Yeah.
Partner. Right. Like they're co-founder, co-owner sort of level
Right.
of equity. And are there differences aside from the amount of equity? Are there differences in how you're structuring them, like in terms of vesting, in terms of deliverables? Like, how are you proactively telling the companies, "Hey, this is what we give you," or are you saying, "What do you want?" Like, how does that conversation go? Because I imagine a lot of these companies don't even know what they should be doing, right? Like, if you aren't already working with creators, you want to be working with creators, you probably aren't exactly an expert on it. So, how are you navigating?
Right. I will answer that by dunking on myself because I think it's the easiest way to do it. I have been a company advisor to companies where it's maybe they'll give me 0.1%, maybe they'll give me 0.5%, and some of them they give me 1%, right? And they'll say, yeah, you have to go and like sit on a quarterly meeting or give advice, or I want this amount of intros. There was no standardization. And frankly, for some of them, I gave the equity back. So I'm like, I don't think I'm helping you. I don't think I necessarily like, it's cool that my name's on the deck, but like, what am I really doing here? You know?
Right.
With these creators, because we have a little bit more like Avi Gandhi's favorite warning math, like we can actually math out a little bit in terms of the multiples of revenue from a company, how much each user is worth, and like it starts to become a little bit easier to know the actual value. Now, the one X factor, which you brought up earlier, is liquidity, right? Unless there is some sort of liquidity event, equity means nothing. It's like literally zero. And therefore, to take on that risk, the way that we have it mathed out, which may not be the right math, but I feel okay about it, is if we pick our companies well, 1 in 10 will have a liquidity event. So if that is true, then we are valuing the equity at about 10% of how you would value cash. So if regularly somebody costs, $10,000 to do a tweet, they'd probably need something that is going to equal in the long run, or so we hope, $100,000 in equity.
Just for one tweet, or just for an engagement that includes a lot more effort?
Based on their goals, right? So we want to make sure that it's, I mean, every company is so different that it's like, do they need an ongoing drumbeat? Do they need, whatever? But we do want to back into influencer marketing standardization, to risk, to equity pool, and make sure everybody along the chain understands that, because every entrepreneur thinks they're giving up too much. Every creator thinks they're not getting enough. So the more that we can kind of show that math along the way and say like, look, I know that this is special and different and absolutely everything, yada, yada. However, industry standards will tell us there's a 90% chance this will equal nothing. And so we have to account for that. We need to make sure that there's ongoing liquidity, which is where like having preferential terms of an affiliate agreement or even like a unique affiliate agreement becomes valuable, or a special coupon. So yeah, I mean, all that to say is we don't know yet, and every company is going to be a little bit different. But what we do want to do is prove out an actual mathematical formula to make sure everybody agrees that the value exchange is right.
So basically, like as an example, if you're a SaaS company and you need to get to 100,000 in ARR to raise your next round, and you're currently at 10,000 in ARR, you might be willing to give up 5% if you were able to get there or whatever. And
Right.
so like the vesting would happen maybe in trenches based on like, okay, you got us enough customers that we're now at 10,000, at 20,000, 30,000, 40. And so you're vesting along the way, you get us to 100,000. Maybe there's a bonus, maybe there's whatever, but like, you've now vested your shares, and probably along the way, the creator is also getting some commission on that revenue as well.
We love that. And that's where predictive analytics is so important, because if we know they have to get to 10,000 users in order to go raise that $50 million round, we're like, all right, that's going to take, we know on average that they're going to convert about 500 people, or that's going to be diminishing returns. So average out over 500 people. So we have to figure out the right drumbeat of 20 shout outs over the course of now to when you're going to go out and raise that round. But if you do and you make millions of more dollars, got to give our creator $100,000 bonus, right? Because you're going to make so much money from this work that like equity is great, but equity alone isn't enough because we've all seen people raise Series A's and Series B's and Series C's and then go out of business, right?
Right.
So finding where those stopgaps are and making those make sense is key.
Super interesting. Let's talk about equity itself as compensation. You know, obviously we've both advised enough companies and had enough equity in companies that we kind of know that like the vast majority of them don't actually end up making you any money. Even if you think it's a great company, it just, that's just how it goes. So, how are you, like, how should creators think about equity? And conversely, when compensating creators, how should companies think about equity?
Yeah. So every company thinks equity is more valuable than it is because everybody is so sure that they wouldn't quit their other job to pursue this.
Right.
If they
That's
didn't
why
think
they're
was gonna
doing
be
it,
an
right?
exit.
Like
Right.
equity is why the founder is doing the thing. Yeah.
Right. But getting them down to earth is like our step one, where it's just like, look, everybody's taking risk here, right? We have to be super picky. It has to be a company that we believe is going to get to a level of exit or liquidity or IPO or whatever. So if it's something where it's like, yeah, that's a really cool idea, but that's not a company, that's a feature. And that's not a company that might be a one off product or there's nothing defensible. Like we have to put on our private equity or VC hats and do a little bit of that. So we got to be super picky. Um, the way that I am able to get more entrepreneurs over the line is to say, look, based on my predictive analytics of a creator like this, your company valuation will double on their first shout out, or you will get 50% more customers than what you have now that you built over a year in 3 weeks if you just give up this. Like, how much of the company is that worth to you? How much would you give to like a co-founder if they were able to promise that, right? And once you're able to start reframing it from, oh, this is just like me giving it up and who knows, to like, no, this is a shortcut. This is a cheat code.
Right.
This is something where we are confident based on past performance that you will get this performance and it will all happen at once, right? Then you start to get people to loosen up a little bit more around that. So not to think of it as like pure marketing, but like, hey, do you want to be at this statistic? This is your way to get you to this statistic, and you don't have to worry too much about it. The creator side is trickier, right? Because creators at that size know their value.
Right.
And that's when I talk about, I always tell the story of my super Catholic mom, right? The Catholic Church, they tell you have to tithe 10%, right? So 10% of everything that you make goes back to the church to help have them do their deeds, right? I believe that creators should be tithing their influence as well, right? Because yes, you need short form liquidity, you need enough money to buy your Lamborghini, you need all of that kind of stuff, right? But there will always be times where you have inventory that you're not using for one of those big brand deals. You know that this video is only going to make $1,000 in AdSense or whatever. And if you can throw something else on there that you really believe in, and it gets you another $5,000 of equity in something that might be something and might be nothing, then like you're buying lottery tickets, right? You're getting scratchers, and maybe if you move the needle enough, then it might be able to be the Magic Spoon story or something else where you're just like, Space Station Investments came in early and exploded, right? So who knows? And the way to get creators across the line on that is you just have to show them a lot of examples of this happening. So the Ryan Reynolds story helps, but also Ipsy and Huda Beauty and even like the stuff where you're seeing I'm forgetting the Sway House guy now, but like, or Space Station, where it's like they're investing, right?
Right.
And they're doing it for a reason. It's because if their creator career goes away, and Sean Duras, I've not looked at his statistics recently, but I think his kids' channel is doing better than his channel, which is awesome. He was able to pivot, but I don't think he was as big as he was during the Snapchat wave.
Right.
And Sway House is not as big as it was during the biggest wave. And luckily, these people were smart enough when they were at the tippy top and could move audiences over to be able to start putting some things in longer term investments.
Right. Well, we got about 5 minutes left. I don't know if the chat is working or not. I mean, I see Brian did wave earlier, but like no one has jumped in. Do we have any questions? Yeah. Can anyone figure out how to hop in the chat and ask questions? And while you do that, I have one more question, which is I would love. Oh yeah, all right, Daniel, I see you. It worked. So chat is working. Throw in questions if you got them.
Perfect.
One last question from me before we take questions from the audience, if there are any, which is, can you share some examples, either from Stealth Talent or from past work and partnerships that you've seen actually drive value? And likewise, maybe some examples, obviously without sharing the creators, where it went wrong and why.
Yeah, I mean, a lot of the examples I have, unfortunately, because it's a relatively new model, are from people that either invested money or just people who did an influencer marketing campaign that had outsized value. Like I remember, and don't shoot me for the name alone, but like when we worked with Logan Paul at Studio 71, he did an app download campaign back in the Vine days and was able to drive hundreds of thousands of downloads for an app for a major QSR company. And I'm like, I remember looking at that and then looking at the amount of money. It was a good rate, but I remember looking at that and being like, oh my God, that was like the cheapest cost per acquisition I've ever seen in my life.
$5 million round off of like $100,000 deal. Yeah.
100%. Right. So like, and I'm sure you've seen a million of these. I've seen a million of these where I'm like putting on my corporate hat and then doing the math in terms of what the company's getting out of it beyond just like dollars and cents, but in long-term value, and going, man, if they owned this, right? If this is something that they had a little bit more, then that would be incredibly outsized value. Where I've seen it not work over and over again is there's like, first of all, David Dobrik Dispo, right? Very hot for a while, was able to get in the app top 10. He had a scandal that was way too tied to him. And this is where we took a learning that we embrace, which is if it's a company that we don't think could survive without a creator or wouldn't be able to stand on its own feet once it's big if the creator were to go away, we probably shouldn't do it, right? Like creators are supposed to be rocket fuel. They're not a crutch, right?
Right.
So that's what we learned we think a lot about Dispo here. Like that's where we're like,
yeah, you're thinking about it like investors, right? Because in a way,
Right.
in many ways, the creator's investing. So if you wouldn't put money into it, you don't want to put your influence into it either.
Totally. Yeah, absolutely.
I'll tell one story where I saw it work, which I think it was 10 years ago. So I think it's okay if I share names and stuff. But, way back in the day, I did a deal for Captain Sparkles. You remember that guy? The Minecraft
absolutely.
YouTuber?
I love Captain Sparkles.
He's awesome. Such a good dude. I did an equity deal for him with a company called Super League Gaming. They were launching like,
there we go.
Like in theater.
They bought Mob Crush.
Minecraft events. Yeah. And they ended up going public. And in COVID at their peak, I think his share would have been worth like a couple $1 million, which is great. I don't know if he ended up, I don't know when he sold, if he sold, like I have none of those details, but like that's an example of where you just don't know what's going to happen. And so there is an element of rolling the dice here, right? And you have to have the appetite for that. But like he saw their product, he was like, oh, like, my audience are kids who like Minecraft. This is a company that's doing like these, like, after school, getting kids in theaters to play Minecraft together. Like, this aligns with my brand. This aligns with like this, what I like. I can add value. And when he did, meet and greets and stuff for them, like tons of kids showed up. So it was like, it was a mutual value for everyone involved. And in the long run, like, assuming that he had the equity and he sold it at the right time or whatever, like, again, I wasn't involved in that, but could have been worth a tremendous amount of money.
Sure. Remember Ryan, that guy that painted the mural for Facebook and then ended up being $1 billion in equity? I think a lot about that too, where I'm like, that was essentially kind of a creator adding creator elements in order to make the brand better. And then
it was like, that was like $100 million worth of equity like 10 years ago. Like today it's probably several billion. Yeah.
That's crazy to me.
Assuming he kept it, and who knows? We got a question from Ryan. Phil, you mentioned your goal is for 1 of 10 to have a liquidity event. Are you pushing each creator to do 10 plus deals to pay the numbers game?
Oh, I've got to give the boring answer again of it depends, right? Like, I think that there's some creators that are so aspirational and their audience are so hungry for things like the LTK style affiliate creators that they could support 30 brands for this, right? Like, because they're just like, saying what's cool, and that's their whole job, is to say what's cool.
And you don't think there's any risk of saturation for those creators? Because that's something I always worry about, and I always tell I actually like advise companies like don't work with creators that are working with too many brands because
Yeah.
they're saturated and their audience is gonna like each incremental brand that they work with will have less attention and interest in the audience from the audience.
Yeah, but these LTK creators are posting like 6 shoppable links a day, right?
That's
Like
true.
people are
That's very
there
true.
for the recommendation.
But I guess
Um,
so sorry. Question on that though is like, do you think that is actually their audience, or is that a discovery game? Right? Like if you look at TikTok
yeah,
Shop, for example, like it's not your audience that's buying it. Like
right,
TikTok is pushing your content to like random people they think will buy.
right.
And so like is Instagram doing the same thing? Like what percentage of like each LTK's creators customers are actually like their diehards versus like
Mhm.
random people the algorithm is serving?
Yeah, and Larry Shapiro will kill me if I share too much of the data that but I have like worked with Larry a little bit on his data story on that. And
Okay.
the shocking result is that it is exceptionally consistent in terms of sales per post that they put up. There are outliers, absolutely, but a lot of times, like the outliers are like the product sucks, or the algorithm tanked the views on that one, or they just had something go like bonkers big.
Right.
But in terms of like the 6 posts a day, I mean, it's not like they're doing tens of thousands of dollars per post, but they're just like creators that they're making $300 per post. And if they put up 10 posts, then they do well. If they're lazy that day, they put up 2 posts, they do okay. But it doesn't generally go up and down based on content saturation because like people are watching like QVC. If they like it, they'll buy it. If not, they won't. But you're right. If it's somebody like Mr. Beast, he's got to be super careful, right? Because like we've
Right.
seen kind of the Snoop Dogg effect with that grill company, where it's
Right.
like if you put your name on too many things, then it's no longer. I mean, it's still special because Snoop Dogg's the man, but like it's
Yeah.
it's
Yeah.
it's less not people aren't desiring to run out and go get
Right.
it,
And as a result, you open yourself up to more criticism, etc.
for sure.
We got another question from Daniel. Hey, Phil and Avi. Hey, Daniel. Since
Hey,
you're working with creators and celebrities at that level where equity would certainly be involved, are you looking for creators more business savvy, actually interested in the product venture, more hands-on and thinking like an owner instead of the common quote unquote white labeled overpriced crappy products positioned as a creator brand? But in reality, just being another brand deal in disguise. Okay, so I think what he's asking is like, are you looking for like, do you distinguish between, do you care about whether it's like a unique product with some sort of like special technology or innovation or invention or whatever it is, or like, is it possible and interesting to like, I mean, like, I'll throw Mr. Beast under the bus here. Like, ViewStats
sure,
X is just TubeBuddy or Creator ML or
right,
any of those other
right.
things, right? So, like, he just took the same product and put his name on it.
Hmm.
But it's working. It seems to be working, right? Like, I don't actually know the
Yeah.
numbers, but like I'm I'm guessing it's working. Like, is
Mhm.
that also a valid model? Like, how do you think about that?
Yeah, I think Daniel, it was a little bit of a leading question based on how he presented the second
Yes,
half of it.
absolutely. I was
But
trying to unlead it, but did not probably do a good job of that.
but I think that Daniel's right on that, right? Which is like you're taking on a heck of a lot more risk if it's an undefensible company. And if it's something where like the creator is saying, hey, look, I think I could just take a chunk of this market based on my influence. So like the blue waters in this market is just that other people aren't marketing as well as we can market, even though this product's the same. We'll look at it, but like, is that what gets me up in the morning and excited to go to work and sell talent every day? Nah. Like, what gets me excited is like, I was talking to somebody who has a microphone company yesterday, and it was such a good microphone company. And he's like, I want creators to be able to show that you can have professional level audio on your phone with a really good UI UX on a small device that's reasonably priced, and check out these results. And I went, oh my God, like mind blown, awesome. I get it. Right. So, like, I think for our own sanity, we're looking for truly special companies. Also, I think it does de risk our time investment that we're putting into it. But yeah, in some cases, we might look over the more kind of white labeled stuff, but it would have to be a really, like, I view stats as a good example. Yeah, for that, but Mr. Beast is a very unique case.
Makes sense. Any other questions? Perfect. Well, thank you everyone for joining. Thank you, Phil, for telling us about Stealth Talent. Actually, you know what? I have one last question, which is
Sure.
Do you consider yourselves talent managers? Are you working with creators who have managers? Like how does that work for Stealth Talent?
Yeah, we have taken on the term of talent representatives, and the reason why is because sometimes we work per project, sometimes we look at the whole thing. So it's, and frankly, a lot of brands, if they say like, "Wait, do you formally work with this creator?" Like, we need to have a title.
Right.
So we needed something that was a little bit more generalist. And what we like about representatives is we are not 360 managers in the way of like, if they go and do a side deal, we're not going to go like sue them. Like, we want to abide by the California Agency Acts and all of that kind of stuff. However, we are absolutely doing and brokering influencer marketing campaigns and platform deals and all of that stuff as well. We're just keeping that reserved for our like fully represented
Your
talent,
exclusive
or the
talent.
ones,
Yeah.
the ones that are putting our email in bio, right?
And what's the commission rate? Like
20%.
Okay, and that includes equity. Like, are you taking equity, or are you commissioning on a liquidity event? How's that work?
We are taking equity as well. The way that we're able to get on that is we have to join the advisory board as well, based on the size of the equity pool. So if somebody wants to give up 10% of equity in order to get a creator advisory board together, we essentially are spending 8% on creators, and then we come in as the 2%.
Interesting. That's an super interesting model. All right. Well, if people want to find you, Phil, where do they find you?
I'm at Phil Ranta on dang near every platform. And you can always find me on LinkedIn or DM me on LinkedIn. That's where I spend most of my social time.
You and me both. All right, everyone. Thanks for joining. I'm Avi Gandhi. Find me on LinkedIn, Avi Gandhi. Find me at creatorlogic.com. Subscribe to the newsletter. And actually, if you're here already, I'm going to subscribe you. So,
your newsletter's a banger too. I've got to give you your flowers. Like, I went through and unsubscribed to a lot of newsletters because everyone has a newsletter now. I did not unsubscribe to yours. I like it.
I appreciate that. That. So yeah, I'll see you all in the newsletter, and thanks for joining.